You open a blank box, type a question, and answers appear in under a second. No invoice, no checkout. That feels like free search. It is not. Google is selling your intent into an advertising auction, then stacking distribution, video, and cloud on top of that core machine. The controlling question is simple. What is Google actually selling when search looks free, and how does the machine keep turning? The naive story says Google sells Search, Maps, Gmail, Chrome, and Android as products. The economic story is narrower and sharper. Alphabet, the public parent, makes most of its money when advertisers bid for moments when you are about to decide. Search looks like a utility. The business is a marketplace for attention attached to commercial intent, with quality score and auction rules shaping who wins the click, how much they pay, and how much Google keeps after paying partners for traffic. That logic started long before the brand became wallpaper. Early Google ranked pages by links as votes, the PageRank insight that made results feel eerily relevant. Relevance pulled queries. Queries pulled advertisers who would pay for placement next to answers. AdWords turned that demand into an auction. AdSense extended the same auction logic onto other sites, so publishers could host Google Ads and share revenue. The company did not merely invent a better library card. It invented a self-funding distribution engine, where better relevance brought more queries trained better targeting, and better targeting raised the value of each auction slot. Ownership matters because this is not a franchise. You do not buy a local Google territory. Alphabet Inc. sits on top as the holding company created in the 2015 reorganization, with Google as the main operating segment for search, ads, YouTube, Android, Chrome, Play, and devices, while Google Cloud and other bets sit beside it in the reporting map. Capex for data centers, custom chips, and networking is company money. In the second quarter of 2026 alone, Alphabet reported about $44.9 billion of capital spending, and management lifted the full year 2026 Capex outlook as high as about $205 billion, largely to scale AI compute. Users do not fund the servers with a search fee. Advertisers and cloud customers do, through the cache engine underneath the free surface. Why own the stack instead of licensing the core? Because the auction only compounds if Google controls the query box, the ranking system, the ad formats, the measurement loop, and major default entry points. Chrome and Android shape where searches begin. YouTube holds another attention surface. Play sits on app distribution. Licensing search as a commodity widget would hand the data flywheel to someone else. Keeping the stack in-house lets Alphabet treat defaults, products, and ads as one machine rather than a royalty stream that slowly erodes control. Android is the clearest example of distribution as economics. The operating system can be open in pieces, yet Google services, Play access, and search defaults have historically been negotiated as a bundle with device makers. That is company-operated leverage, not a franchise fee schedule. Chrome does similar work on the desktop and laptop side by making Google Search the path of least resistance. Own the door, and you own more of the auctions behind it.
Walk one transaction. You type a query with buying intent, say a mid-range laptop model. Google runs an auction among advertisers targeting that phrase or related intent. Historically, the system grew from second-price auction heritage, where the winner often paid based on competition rather than their own maximum bid, later evolving in design while still using bids plus quality signals. Quality score is the plain speech idea that expected click-through, ad relevance, and landing page experience affect rank and cost. A higher quality advertiser can win with a lower bid than a spammy rival. If you click, the advertiser typically pays on a cost per click basis. If you only see an impression-priced format, the math is cost per 1,000 impressions. Google recognizes advertising revenue. Separately, traffic acquisition costs, or TAC, are what Alphabet pays distributors and partners to send query traffic or place ads. In the second quarter of 2026, Alphabet reported about $16.2 billion of TAC against about $81.6 billion of Google advertising revenue in that same quarter. That is not a proprietary cost per query ledger. It is the public proxy for how much of the ad machine is shared with Apple, carriers, browsers, and publishers to keep the defaults and inventory flowing. Per query unit math is where honest labeling matters. Alphabet does not publish a clean sense of COGS figure for serving one organic search. Industry commentary sometimes guesses fractions of a cent for incremental query cost, but that is not a company disclosure, so treat any such figure as an outside estimate, not a filing fact. What filings do show is scale. For full year 2025, Alphabet reported about $224.5 billion of Google search and other revenue, about $40.4 billion of YouTube ads, about $29.8 billion of Google network ads, and about $294.7 billion of Google advertising in total, inside about $402.8 billion of company revenue. Divide search and other by billions of daily queries, and you only get a rough revenue per query proxy, not true profit per search, because infrastructure, TAC, R&D, and shared costs do not allocate that cleanly in the 10K. Pixel phones are different again. Hardware carries product cost of goods. Search ads are platform economics. Mixing them muddies the machine. Network ads through AdSense and related products show the partner face of the same auction. A publisher runs Google code, an ad fills, and revenue is shared. That extends Google inventory beyond owned properties, but it also creates tension when publishers argue the take is too high or the auction rules favor Google tools. The network line is smaller than search and has been softer in recent reported periods, which is a reminder that not every layer of the machine grows at search speed. Pricing psychology is the auction itself. Advertisers do not see a simple sticker price for a keyword. They see competition, quality thresholds, and the fear of missing the click when a shopper is ready. That uncertainty is a feature. It pulls budgets toward the queries that convert, and it makes switching costly once campaigns, creatives, conversion tracking, and institutional knowledge live inside Google Ads. On the consumer side, loyalty looks like habit. Gmail, Photos, Maps timelines, YouTube history, Chrome Sync, and Android defaults create switching friction without a classic membership fee. Changing search engines is easy in theory and sticky in practice when the box is already there and your account graph spans half your digital life. Float here is habit and identity graph more than cash held on a balance sheet. The next query, video, and map check-in still route through Alphabet properties. Subscriptions add a second loyalty rail. Paid YouTube and Google One turn some users into recurring billers instead of pure ad inventory, diversifying cash without abandoning the auction core.
The layered money machine is visible in Alphabet's segments. Google services still dominate, about $342.7 billion in 2025, spanning search ads, YouTube, network, subscriptions, platforms, and devices. In the second quarter of 2026, Google services brought in about $94.5 billion, with search and other about $63.3 billion, YouTube ads about $11.1 billion, and subscriptions, platforms, and devices about $12.9 billion. YouTube is no longer a side bet. Across ads and subscriptions, Alphabet said YouTube exceeded $60 billion of revenue for full year 2025. Google Cloud is the second engine, about $58.7 billion for 2025, then about $24.8 billion in a single quarter in 2026, up 82% year over year, with segment operating income about $8.8 billion and operating margin about 35.6% that quarter, plus backlog reported around $514 billion. Other bets remain small on revenue and often loss-making as experiments, with Waymo-style bets soaking capital while search funds the empire. Play take rates on apps, hardware like Pixel, and consumer subscriptions such as YouTube Premium and Google One thicken the stack, but advertising remains the cash core. In the second quarter of 2026, Google Services operating income was about $39.5 billion on roughly $94.5 billion of segment revenue, an operating margin near 42%. That margin is the quiet proof that intent auctions, once scaled, can throw off enormous cash after the servers and partner checks. If you're getting something useful from this so far, a like and a subscribe help keep these breakdowns coming. Now back to Google. The moat is a flywheel spoken in one breath. More queries produce more click and conversion data. Better data improves ranking and ad matching. Better matching raises advertiser willingness to pay. Higher payouts fund defaults, products, and infrastructure. Better products pull more users. Distribution deals closed the loop. In 2021, trial evidence highlighted about $26.3 billion paid to be the default search engine across phones and browsers. Reporting around the case also put Apple's 2022 default payments near $20 billion, with testimony describing a large revenue share percentage on Safari search ads. Those checks are not charity. They buy the first screen, which buys the data, which buys the next auction advantage. Supply chain here is electricity, silicon, land, and labor. Alphabet pays for campuses of servers, networking gear, and increasingly custom tensor processing units for training and serving models, including TPU system sales recognized in cloud results in 2026. Headcount was about 198,933 employees at the end of the second quarter of 2026. Long-lived assets concentrate heavily in the United States, with a large international tranche for data centers and offices. Revenue geography for 2025 shows about 48% United States, about 29% Europe, the Middle East and Africa, about 17% Asia Pacific, and about 6% other Americas, based on customer addresses. The ad machine is global, but the balance sheet still leans on U.S. infrastructure and U.S. demand.
The dark side is not a cartoon villain arc. It is structural tension made visible in court. In August 2024, U.S. District Judge Amit Mehta found that Google maintained illegal monopolies in general search services and general search text advertising, writing that Google is a monopolist and had acted as one to maintain that monopoly. Google has disputed the government's theory and has appealed aspects of the remedies. In December 2025, the court entered a final judgment with behavioral remedies, including limits on exclusive default contracting and requirements around data access and syndication frameworks, while rejecting a forced Chrome breakup at that stage. Into 2026, those remedies were moving into implementation under technical committee oversight, even as both sides pressed appeals in the D.C. Circuit, with the government arguing for stronger structural relief and Google challenging constraints it says go too far. Separately, in April 2025, U.S. District Judge Leonie Brinkema found that Google illegally monopolized open web publisher ad server and ad exchange markets and unlawfully tied key tools. Google said it would appeal. Into August 2026, the ad tech remedies decision remained unresolved after the remedies trial, so liability stood while the fix was still being written. Privacy controversies and publisher fights over ad economics sit beside those cases as pressure on trust, distinct from any criminal conviction. None of this cancels the machine. It prices legal and political risk into how durable the defaults and ad stack remain. Competition is a stack, not a single rival. Microsoft's Bing and Copilot chase the query, especially when bundled beside enterprise software. Apple can threaten the default deal or steer more on-device search. Amazon pulls retail intent into its own ad marketplace once the shopper is already on a product page. Meta sells social attention. TikTok sells entertainment attention that can substitute for some discovery. None of that automatically inherits Google's combination of navigational search habit, advertiser tools lock-in, and default placement. Displacing Google still means matching relevance, advertiser tools, Chrome and Android distribution, YouTube reach, and cloud scale at once. That is why layered ownership is hard to unwind with a single product launch. The portable lesson is not that Google is immortal, it is that a free consumer surface funded by a competitive auction becomes durable when distribution contracts and data feedback loops reinforce each other. Hold this picture. Free search is the storefront, the register is the auction. Defaults are the lease on the corner. Cloud and subscriptions are new floors on the same building. In 2015, Alphabet's holding company split made the corporate map match that idea, separating core Google from other bets without selling the crown jewels. In 2006, Google closed the YouTube purchase for about $1.65 billion in stock. That bet now throws off tens of billions a year across ads and subscriptions. Structural deals reshaped the economics more than slogans ever did. So when search feels free, remember who invoices whom. You bring intent, advertisers bring bids, partners bring defaults, Alphabet brings the auction, the stack, and the Capex. That is the economics behind Google. There's a written business guide linked in the description if you want this broken down further. If this helped you see how the machine actually works, like the video and subscribe to Terminal Value. Thanks for watching.